welcome you all in my YouTube channel and in this video also. I think this particular video on redemption of preference share will be very helpful for the students of commerce in any form, that is from higher secondary to any kind of professional course, who are studying this particular portion of Companies Act 2013, because this particular video has been classified into two parts. The first part will be discussed about the regulatory requirements of Companies Act regarding the redemption of preference share, that deals with section 55 of the Companies Act. In due course of time, we will let us know about the journal entries, that is accounting treatment, and finally I try to solve one problem in this particular video. So I think this video will be very helpful. If you are having any queries, any questions, you may drop a mail or you may write in that particular comment box. So without wasting much time, I am entering into my lecture on redemption of preference share. So keep watching this video with patience. Now with this video, what you will get to know, that what are the learning objectives of this particular video. With this video, we will get to know the basic concept and meaning of redemption of preference share. That is, what is redemption of preference share. We will also get to know the provisions of the Companies Act 2013 in this particular segment. You will also know the different methods which are used for the purpose of payment of redemption of preference share. You will also know the logic behind creation of capital redemption reserve, that why CRR account is being created, and finally the accounting treatment and accounting entries related to redemption will also be covered in this particular video. Now, as we all know that shares are being two types, that is equity share and preference share. These are being the basic subdivision of share. Now, I think this is very common to all, that what is share, what is equity share, what is preference share. So, I am not entering into that particular portion, that what is equity, what is preference, and so on. Now, we start with the introduction, that why redemption of preference share is required and what is it. As per the Companies Act 2013 section 55, all the companies should issue redeemable preference share only. That means no company may issue irredeemable preference share. That cannot be done. And the redemption must be carried on within 20 years, maximum 20 years from the date of issue. That is the maximum ultimatum that the company need to redeem its preference share within 20 years from the date of issue. Now, what is the term of redemption? That why this redemption term is being considered? Because redemption is known as return of the capital money, share capital money to the shareholder. That means within 20 years from the date of issue, all the preference shareholder will get back the money they have invested in terms of in preference share. So what are the regulatory requirement under section 55 of the Companies Act? That section 55 subsection 1 of the Companies Act states that no company can issue irredeemable preference share. That is the first thing. Second part is that all the preference share cannot be redeemed unless they are fully paid up. So any partly paid up share cannot be redeemed. That is the second one. The third one is that the company should or may issue fresh equity or preference share for the purpose of the redemption of preference share. Or the company may redeem all the preference share out of their balance in free reserve. Now, what is free reserve? Free reserve is the balance of reserve and surplus which are available for the purpose of free distribution of dividend. So, if any balance is lying with the general reserve or profit and loss account for the purpose of dividend payment, that can be utilized as free reserve, and that can be utilized for the purpose of creation of CRR. So if the company may mix it up, that certain percentage, certain proportion of the shares are being redeemed out of fresh issue, and certain proportion of redemption can be carried out from the past accumulated free reserve. But if the company may utilize its free reserve balance, that the equivalent amount of free reserve which are being utilized for the purpose of redemption, the amount should be transferred to one designated account which is known as capital redemption reserve account. And I'm getting back with that particular thing, that why capital redemption reserve is being created. Okay, now it is very important that for the purpose of redemption of preference share, the capital of the companies are being eroded. That means by way of redeeming preference share, the capital of the companies goes down. So to stop this erosion, either the company issue free equity or preference share, or the company may block its free reserve balance. I am repeating once again. To stop the capital erosion, the company may capitalize their revenue or free reserve profit balance by way of creating CRR, that is capital redemption reserve account. If CRR is being created, the amount which are available for the purpose of free distribution of dividend will keep blocking. So that is the logic behind creation of CRR account. Okay. Now these important points you should remember, that for the purpose of redemption, fresh issue of debenture, taking of loan, sale of any asset will be considered as liquid cash for the purpose of payment of dividend, but these cannot be considered as a part of the regulatory requirement. Okay. The capital profit, such as that particular capital redemption reserve account, is purely created for the purpose of issuing bonus share, nothing else. Okay. Now I am entering into the journal entries for redemption of preference share. If the shares are partly paid up, then the company needs to convert it to fully paid up. That means the company need to call the final call amount. So what will be the journal? Preference share final call account debit to preference share capital account, then bank account debit to preference share final call account. By way of this, the partly paid up share are being considered as fully paid up. Okay. Now this is the second journal, that is amount due to preference shareholder. If the shares are redeemed at face value or at par, the entry will be redeemable preference share capital account debit to preference shareholder account. If the shares are redeemed at premium, in that case the journal will be redeemable preference share capital account debit, premium on redemption account debit to preference share capital account. Okay. Now if the company try to issue fresh equity or preference share, in that case what will be the journal? If the company are issuing fresh equity or preference share at par, the entry will be bank account debit to equity share capital account. If that are being issued at premium, the entry will be bank account debit to equity share capital account to securities premium account. If the fresh equity or preference share are being issued at discount, the entry will be bank account debit, discount on issue of share account debit to equity share capital account. But nowadays, as per the Companies Act 2013, discount on issue of share, that is shares issued at discount, is not possible. So that criteria will be struck off. So either it will be issued at par or it will be issued at premium. Okay. Next, the fourth journal. For the purpose of redemption, if premium on redemption is being given, at the first journal I have mentioned that if premium on redemption is being given, that has to be adjusted against either securities premium or free reserve balance. First, we will try to utilize out of securities premium account. So the entry will be securities premium account debit to premium on redemption account. If the company fails to utilize its securities premium due to shortage of balance, it may utilize statement of profit and loss or general reserve for the purpose of treatment or for the purpose of adjustment for premium on redemption. Now, if the company utilize its free reserve balance, in that case, the company needs to create CRR account. What will be the journal? Statement of profit and loss account debit, general reserve account debit to CRR account. It will be the journal entry for creation of CRR. Then, if for the purpose of liquidity, if the company wants to sell off its asset, you have to pass such entry, that is bank account debit to asset account if sold at book value. If it is sold at profit, the entry will be bank account debit to asset account to statement of profit and loss. If it is sold at loss, then bank account debit to statement of profit and loss account debit to asset account. If for the purpose of liquidity also, if the company wants to take a bank loan, the journal will be bank account debit to bank loan account. And finally, the payment of preference shareholder account debit to bank account. It will be the final journal. Then, if the company utilize its CRR balance for the purpose of providing bonus, what will be the journal? That CRR account debit. If it require more amount for the purpose of bonus, it may be out of its securities premium balance or any other reserve balance to bonus to equity shareholder account. So capital CRR account debit, securities premium reserve account debit, any other reserve account debit to bonus to equity shareholder account, and finally bonus to equity shareholder account debit to equity share capital account. So if you think about chronologically, what are the journal entries? The first to block for capitalizing its free reserve, that is blocking capital erosion, the entry was general reserve account debit, profit and loss account debit to CRR account. That means the amount has been transferred to from general reserve to CRR. Then CRR to bonus to equity shareholder, then bonus to equity shareholder to general equity share capital. So finally we can say that the amount are being transferred from general reserve profit and loss balance to equity share capital account. So that is the main logic of creation of CRR, for blocking CRR, for blocking its revenue profit, or rather the revenue profit has been capitalized in that particular form. Next, I will move forward a problem that will be given by solution that will be given. Now I am moving forward for the problem. Now this is the problem that as on 31st March 2006, the balance sheet of X Limited is given below, and the share capital is 1,40,000. The reserve and surplus is 55,000. Total balance sheet total is 2,25,000. So we will move forward for the notes to accounts and other things. The notes to accounts of the company is 500 redeemable preference share of rupees 100 each, 50,000, 9,000 equity share of rupees 10 each, fully paid up 90,000. This is the balance of reserve and surplus and tangible asset. The company decided to redeem its preference share at premium of 5% on 21st April 2026. A fresh issue of 1,000 equity share of rupees 10 each was made at rupees 12 per share, payable full on 2nd April 2026. That has been done for the purpose of redemption of preference share. These shares were fully subscribed and all money were fully collected. All the investments were sold at rupees 27,000 on 23rd April 2026, and it is purely for the purpose of liquidity. And finally, preference shareholders are paid up on 25th of April 2026. The director wished that a minimum reduction should be made on the revenue reserve, that is on general reserve, minimum reduction should be made. You are required to pass journal entry and draw up the balance sheet after the redemption. Now it is the solution. On 2nd April, the shares 1,000 equity share which are being issued at a premium of rupees 2 each will be issued. Now for this, the entry will be bank account debit 1000 into 12 to equity share capital account, 1000 into 10 to securities premium account, 1000 into 2. Then preference share will be due. All the preference share, redeemable preference share were fully paid up. So there is no problem with that. We need to due to the preference shareholder at a premium of 5%. So the entry will be redeemable preference share capital account debit, premium on redemption account debit to preference shareholder account. Premium will be 5% on the capital value. Then investment of rupees 28,000 gets sold at a loss of rupees 1,000. So for that you have to pass the journal, that is bank account debit 27,000 selling price. Loss will be transferred to profit and loss account 1,000 to investment account 28,000. Now you have to transfer the remaining amount to capital redemption reserve. Now how to calculate the remaining amount for the amount to be transferred to CRR? You have to keep it in view of this workings one. The face value of preference shares to be redeemed 50,000 and face value of equity shares issued rupees 10,000. Equity shares are issued at premium, but we have to consider the face value up to the face value only. So it is 10,000. So amount to be transferred to CRR account is simply 40,000. I think it is very clear. Face value of preference shares to be redeemed 50,000, less face value of equity shares to issued at premium 10,000. So amount to be transferred to CRR is 40,000. So as the minimum reduction to be maintained in reserve, that is general reserve, we have to maximize profit and loss, then general reserve. Now in profit and loss balance there was 25,000. 1,000 was loss, has been adjusted for the purpose of loss on sale of one asset. So the balance comes at 24,000. So profit and loss account debit 24,000, remaining is capital general reserve account 16,000 and to CRR account, that is capital redemption reserve 40,000. Finally, the premium on redemption will be adjusted against securities premium reserve account, that is securities premium reserve account debit to premium on redemption account. And finally, the preference shareholders will be paid off, that is preference shareholder account debit to bank account. So that will be the part of our journal entry. Next, we will move forward for the revised balance sheet. Now, this is the revised balance sheet just after the redemption of preference share, which stood at share capital 1 lakh, reserve and surplus, current liabilities along with the other fixed asset, tangible asset and bank balance. So I will move forward for the notes to accounts. The notes to accounts is like that 9,000 equity share was there. Now 1,000 equity share were issued. So in total 10,000 equity share of rupees 10 each, which are fully paid up 1 lakh. No preference share is there. Securities premium reserve was 10,000. Along with that, new premium has been collected 2,000 and 2,500 has been distributed as premium on redemption. So finally it is 9,500. General reserve balance was there 20,000, 16,000 has been transferred to CRR. So balance stood at 4,000. Statement of profit and loss was there 25,000, 1,000 loss was adjusted for investment and 4,000 has been transferred to CRR. So balance is nil. Finally CRR has been created, that is 40,000. So it will be total capital redemption reserve balance plus general reserve securities premium balance. So total reserve and surplus. Along with that, no change in fixed asset. The change in capital, cash and cash equivalent, that is opening balance was 20,000. Next, share issued at premium 12,000. Sale proceeds of investment 27,000. Total was 59,000. Out of which preference shareholders were paid up by 52,500. So closing cash and cash equivalent is 6,000. So with this, I just conclude my presentation. I request all of my users, if you are having any queries, please let me know in my mail ID or you can write in the chat box in this particular video. So thank you for watching my channel. Keep watching. I will update it with more and more videos which are related to your study. So thank you all.